Most people believe wealth disappears when markets crash. They imagine red charts, breaking news, headlines screaming panic. And they assume one thing, that someone, somewhere, just lost everything. But here's the uncomfortable truth. Wealth doesn't vanish when markets collapse. It moves, quietly, deliberately, from those who don't understand the system to those who do. Let me ask you something. If asset prices fall in 2026, who actually loses money? Is it the person who owns stocks? The homeowner watching prices decline? The retiree holding safe income assets? Or is it something deeper, something almost no one talks about? Because here's the paradox most people miss. Sometimes knowing which assets will fall is far more valuable than knowing which ones will rise. Imagine this. Two people enter a market downturn. One watches prices fall and freezes. They hold tighter. They hope things go back to normal. The other sees the same crash and quietly starts rearranging their position. They don't panic. They don't chase headlines. They don't guess tops or bottoms. They simply understand how money flows, and when the dust settles, only one of them is wealthier. History has shown this pattern again and again. In 2008, in 2020, in every major financial reset. When the system shakes, most people react emotionally, but a small group responds strategically. They don't fight the collapse. They use it. This video is not about predicting the future. It's about understanding the mechanics behind it. Because 2026 isn't shaping up to be a random downturn. It's shaping up to be a repricing event. A moment when multiple asset classes, assets long considered safe, stable, even untouchable, begin to lose value at the same time. And when that happens, money doesn't disappear. It simply looks for a new home. In this episode, we're going to do three things. First, we'll uncover why market crashes don't destroy wealth. They redistribute it. Second, we'll break down 5 types of assets most at risk in 2026 and why the danger isn't obvious until it's too late. And finally, we'll explore where capital tends to move next. Not based on hype, but on historical behavior and financial incentives. This isn't about fear, it's about clarity. Because when you understand the rules of the game, panic loses its power, and preparation becomes an advantage. Welcome to the Hidden Mind, where we don't follow the noise of the market, we follow the flow of money. Let's begin. There's a misunderstanding almost everyone carries with them. It starts early, sometimes without us even realizing it. We're taught that when markets rise, people get rich, and when markets crash, wealth is destroyed. It sounds logical. Prices go down, portfolios shrink, news anchors talk about trillions wiped out. So the conclusion feels obvious. Someone must have lost everything. But here's the quiet truth most people never stop to examine. Wealth doesn't disappear when markets crash. It changes hands. Think about it for a moment. When a stock falls from $100 to $50, did the money vanish? Or did someone sell and someone else buy? Because every transaction still has two sides. One person exits in fear, another steps in with patience. And the difference between them is not intelligence, not luck, but understanding. Let me tell you a simple story. In 2008, during the financial crisis, millions of Americans watched their retirement accounts collapse. People sold because they were scared. They needed certainty. They wanted the pain to stop. At the same time, a much smaller group was doing the opposite, quietly buying. Not because they were fearless, but because they understood something crucial. They weren't buying prices. They were buying future cash flows, productive assets, and long-term purchasing power. When the panic passed, and it always does, those assets didn't just recover, they multiplied. The wealth never vanished, it simply moved. The same pattern repeated in 2020. Markets crashed faster than anyone thought possible. Headlines screamed disaster. People sold at the bottom. And yet, within months, assets were back near all-time highs. So ask yourself this: if crashes truly destroyed wealth, how did it keep reappearing in the same hands? The problem isn't the market. The problem is how most people measure wealth. They look at price charts, account balances, daily fluctuations. But price is only a snapshot. Wealth lives deeper than that. It lives in ownership, in control, in the ability to hold when others cannot. Here's where the misunderstanding becomes dangerous. Most people believe safety means avoiding downturns, so they cling to what feels stable: cash, safe income assets, things that promise comfort instead of volatility. But safety in financial markets is often an illusion, because what feels calm on the surface can quietly erode your purchasing power underneath. And what feels chaotic, market crashes, volatility, uncertainty, is often where the biggest transfers of wealth take place. Let me make this very clear. Crashes do not reward bravery. They reward preparation. They don't favor those who guess bottoms. They favor those who understand where money goes when fear takes over. Here's the small lesson most people learn too late. If you only know how to make money when assets rise, you're not an investor, you're a passenger. True investors understand both sides of the cycle. They know how wealth is created on the way up and how it's redistributed on the way down. And this brings us to the real question. If wealth doesn't disappear during crashes, where does it go? Because money always moves with intention. It flows toward safety, toward yield, toward narratives that promise stability or growth. And once you learn to follow that flow, the market stops looking like chaos. It starts looking like a map. In the next section, we're going to talk about that map, about the one question that matters more than predictions, more than headlines, more than fear. The question that quietly separates those who lose wealth from those who accumulate it. Where does money actually flow when everything else is falling? There's a moment every investor eventually reaches, a moment when they stop asking, which asset will go up next, and start asking a very different question. Where is money actually going? Not where headlines say it's going, not where social media is shouting, but where capital is quietly moving beneath the surface. Because money, unlike people, rarely panics. It adapts, it relocates. It seeks the best balance between safety, return, and control. Most people watch markets the way they watch the weather. They look at today's temperature, today's storm, today's sunshine. But experienced investors watch the seasons. They understand that money moves in cycles, and those cycles repeat far more often than we'd like to admit. Let me give you a simple example. When uncertainty rises, money doesn't instantly chase growth. It first looks for safety. That's why, during global crises, you often see capital rushing into US dollars, government bonds, or large institutions, regardless of whether those places are truly safe in the long run. Not because they're perfect, but because they're familiar. Money behaves a lot like people in a crowded room. When the lights go out, everyone moves toward what they recognize. But safety is only the first stop. Once fear settles, money starts asking a second question. Where can I earn yield without taking excessive risk? This is where you see shifts into income assets, commodities, or defensive sectors. And finally, when confidence returns, money begins to seek growth again. Innovation, technology, productivity. This sequence, safety, yield, growth, isn't theory, it's history. Here's something most people miss. Money doesn't move all at once, and it doesn't move evenly. Large institutions reposition months, sometimes years, before retail investors even realize a cycle has changed. By the time the average person feels safe enough to act, the smartest money has already moved on. Think back to early 2020. When markets collapsed, most people froze, but capital didn't. It rushed into liquidity, then into assets tied to technology, productivity, and scale. By the time the public felt confident again, those assets were already expensive. The flow had already passed. This is the uncomfortable part. You don't need to predict the future to follow money. You just need to observe incentives. Ask yourself, who is forced to sell right now? Who can afford to wait? Who benefits from fear? And who pays the price for it? Money always flows toward those answers. Here's the small lesson. Markets are not moved by opinions. They're moved by constraints. When people must sell, prices fall. When people can wait, they gain leverage. Understanding this turns the market from a guessing game into a system. And this brings us to the next piece of the puzzle. Because right now, one of the largest and most trusted destinations for global money is quietly changing. An asset long considered untouchable, risk-free. The foundation of the entire financial system. In the next section, we're going to talk about what happens when that foundation begins to crack, and why U.S. government bonds, once the ultimate safe haven, are no longer behaving the way the world expects. Let's take a closer look. For decades, U.S. government bonds carried a quiet promise. No drama, no excitement, just safety. They were called risk-free, not because nothing could ever go wrong, but because the world trusted one idea above all else: that the United States would always pay its debts. And for a very long time, that trust was enough. If you were a pension fund in Europe, a central bank in Asia, or a conservative investor planning retirement, U.S. Treasuries were the anchor. You didn't buy them to get rich. You bought them to sleep at night. They were the place money went when everything else felt uncertain. But something subtle has changed. Not overnight, not loudly, quietly. Today, U.S. government bonds still pay interest. In fact, they pay more interest than they have in years. And yet, their prices are falling. That confuses a lot of people. How can something offering higher yields be losing value at the same time? The answer is simple, but uncomfortable. Because bonds are not just about income. They are about confidence. Let's slow this down. When interest rates rise, new bonds pay more. That makes older bonds, with lower rates, less attractive. So their prices fall. This part is mechanical, textbook. But what's happening now goes deeper than math. Foreign holders, countries that once absorbed massive amounts of U.S. debt, are no longer buying the way they used to. Some are reducing exposure, others are stepping back entirely. Not because America is about to collapse, but because trust is no longer blind. And in financial markets, the moment trust becomes conditional, pricing changes. Think of it like lending money to a friend. When you trust them completely, you don't worry about interest. But once doubt appears, even a small one, you start asking for better terms, higher rates, shorter timelines, more protection. That's exactly what the bond market is doing. Here's a real-world consequence most people never see. Banks, pensions, and insurance companies are some of the largest bond holders on Earth. They don't trade bonds for fun. They need them for stability. When bond prices fall, their balance sheets weaken. Not dramatically at first, but persistently. And that's how financial stress begins: quiet, slow, uncomfortable. Here's the small lesson hidden inside all of this. Safety is not a label. It's a relationship. And relationships change. U.S. government bonds aren't suddenly worthless, but they are no longer unquestioned. And in markets built on confidence, that alone is enough to matter. Now here's where things get even more interesting. Because when bonds, the foundation of the financial system, start to wobble, money doesn't stop moving. It looks for the next place to hide. And very often, that place isn't another asset. It's cash. But as we're about to see, cash has its own quiet risk. In the next section, we'll talk about why holding money can feel safe, while slowly losing the one thing that truly matters: purchasing power. Let's continue. When uncertainty rises, people do something very human. They seek comfort. And in financial markets, comfort often looks like cash. No volatility, no red charts, no sleepless nights, just numbers sitting still. For many people, holding cash feels like stepping out of the storm. But here's the quiet danger almost no one talks about. Cash doesn't scream when it loses value, it whispers. Let me explain. When you hold cash, you're not just holding money, you're holding a claim on future purchasing power, and that claim only matters if what your money can buy tomorrow is roughly the same as what it buys today. The problem is, that's no longer guaranteed. Think back just a few years. Groceries, rent, energy, healthcare. Nothing exploded overnight. Prices simply crept higher. Slow enough that people adjusted. Fast enough that savings quietly shrank. No headlines saying your cash just lost value. It just happened. Here's a simple way to see it. If you kept $100,000 in cash 5 years ago, you still have $100,000 today. But try buying the same lifestyle, the same house, the same services, the same sense of security. You'll feel the difference immediately. Now, here's where many people get confused, especially in the US. They hear the dollar is strong, and that's true in comparison to other currencies. But strength against other money is not the same as strength against real life. You don't spend dollars competing with euros or yen. You spend them competing with prices. This is where cash becomes deceptive. It feels stable. It feels responsible. It feels safe. But safety without purchasing power is just stillness. And stillness, in an inflationary environment, is erosion. Let me tell you a quiet truth. Institutions understand very well. They don't hold large amounts of cash because they trust its long-term value. They hold it for optionality, to move quickly, to buy when others can't, to reposition when conditions change. Cash is a tool, not a destination. Here's the small lesson hidden in all of this. Cash is not king. Control is. Cash only protects you if you know when to deploy it. Otherwise, it becomes the most comfortable way to slowly fall behind. And this leads us to the next layer of risk, because many people, realizing cash is losing power, try to solve the problem by chasing income, dividends, yields, monthly payouts that feel reassuring. But in a world where so-called risk-free assets pay more than ever, those income strategies carry a danger of their own. In the next section, we'll talk about why yield-focused assets, once considered safe, are quietly being repriced, and why chasing income in the wrong cycle can cost far more than it gives. Let's continue. When cash begins to lose its comfort, people often look for the next safest thing. Not growth, not speculation, income. Something steady, predictable, reassuring. Dividends, REITs, income funds that promise monthly checks and quiet nights. For years, these assets felt like the perfect compromise. A little risk, a little reward, and a sense of control. But markets change, and sometimes they change the rules so subtly that people don't notice until the damage is done. Here's the shift most investors are struggling to adapt to. For the first time in a long time, risk-free assets are paying real returns. Government bonds, treasuries, instruments once dismissed as boring. They now offer yields that compete directly with dividend stocks and income strategies. And that changes everything. Let's make this practical. Imagine you're a retiree. You own a portfolio of dividend stocks yielding 3%. It's stable. It's familiar. Then suddenly, risk-free bonds start paying 4 or 5%. No volatility, no earnings risk, no sleepless nights. What do? You don't need to panic. You simply rebalance. And when millions of investors make that same rational choice, prices adjust. This is the part many people miss. Yield assets don't fall because they're bad businesses. They fall because they're being repriced. If an income asset pays the same cash flow, but safer alternatives now pay more, the only way to compete is for price to fall. We've seen this story before. In previous rate cycles, high-yield stocks looked attractive until interest rates normalized. Then, quietly, capital rotated out. Not all at once, not dramatically, but persistently. And those who bought income for safety watched their principles slowly erode. There's a deeper layer here. Many of these yield assets are held by institutions that must generate income: pension funds, insurance companies, endowments. When yields elsewhere rise, they're forced to adjust, not because they want to, because their models demand it. And forced adjustments create pressure. Here's the small lesson hidden inside this shift. Income is not safety if it comes at the cost of capital. Yield feels comforting, but comfort can be expensive in the wrong cycle. True safety isn't about how much cash an asset pays today. It's about whether that asset can hold its value when the environment changes. And this brings us to a risk most people never connect to income assets. Because when yields rise and asset prices fall, the pressure doesn't stop with investors. It moves into the financial system itself, into balance sheets, into banks, into places that rely on assets holding steady. In the next section, we're going to talk about one of the quietest and most dangerous areas where this pressure is building: commercial real estate, and why it's not just a property problem, it's a banking problem. Let's take a closer look. If you walk through many downtowns today, you can feel it before you see it. Office lights still on, but fewer people inside. Elevators that once ran nonstop now pause between floors. Buildings that look fine from the outside yet feel strangely empty on the inside. Commercial real estate didn't collapse overnight. It's been quietly losing its purpose. For years, office buildings were considered some of the safest assets around. Long-term leases, predictable rent, reliable tenants. Banks loved them. Investors trusted them. Cities were built around them, but something fundamental has changed, not because of one crisis, but because of behavior. Remote work didn't just alter where people sit, it altered how space creates value. Companies realized they didn't need as much office space. Retail shifted online faster than expected. Foot traffic never fully returned. And suddenly, buildings designed for yesterday's economy were competing in a world that had already moved on. Here's where the real problem begins. Most commercial real estate isn't owned outright, it's financed. With loans, with leverage, with assumptions that rent would always cover debt. When occupancy drops, cash flow weakens. When cash flow weakens, loan risk rises. And when enough loans come under pressure, banks start to feel it. This is why commercial real estate isn't just a property story, it's a balance sheet story. Banks hold these loans as assets. When property values fall, collateral weakens. Not instantly, not explosively, but slowly enough to escape headlines. Think back to 2008. The danger didn't come from houses alone. It came from how those houses were used to support the financial system. Today's situation is different, but the structure feels familiar. Assets assumed to be stable are quietly losing value, and banks are caught in the middle. Here's a real-world example. Many regional banks hold a disproportionate amount of commercial real estate loans. They don't have to the scale of global institutions. They don't have the same flexibility. When refinancing becomes difficult, when rates rise and valuations fall, those banks are forced to make hard choices: raise capital, reduce lending, or absorb losses. None of those outcomes are painless. Here's the small lesson hidden inside this story. Risk doesn't always arrive as a crash. Sometimes it arrives as stagnation, as assets that no longer generate enough to justify what they're worth. Commercial real estate is teaching us something important. Assets don't fail because they're bad. They fail because the world they were built for no longer exists. And this leads us to an uncomfortable realization. when bonds are under pressure, when cash is losing power, when income assets are being repriced, and commercial real estate is quietly weakening. Where does money go next? The answer, for many investors, feels obvious. Stocks, the stock market, the place growth is supposed to live. But as we'll see next, even equities carry a risk most people underestimate. Not because they're bad investments, but because narratives can become traps. In the next section, we'll talk about how the stock market itself can become the most convincing illusion of safety. Let's continue. When bonds feel unstable, when cash quietly loses power, and when income assets no longer feel safe, most people turn to one place almost instinctively: the stock market. It feels familiar. It feels alive. It feels like growth. And for many investors, especially in the US, stocks don't just represent opportunity. They represent belief. For generations, the story has been simple. America grows, companies innovate, stocks go up over time. And most of the time, that story has been true. But here's where things become dangerous. Stories don't fail all at once. They fail when people stop questioning them. Let's slow this down. The stock market is not the economy. It never has been. It's a reflection of future expectations, filtered through liquidity, incentives, and narrative. When money needs a home, stocks often become the most convincing place to send it. Not because they're always cheap, not because risks have disappeared, but because the story sounds reassuring. Think about recent years. Economic data comes out mixed. Inflation pressures linger. Debt levels rise. And yet, markets rally. Why? Because capital needs somewhere to go. When bonds lose appeal and cash feels passive, stocks become the default destination, especially large, familiar companies, the names everyone recognizes, the businesses that feel untouchable. This is how the narrative trap forms. A small group of stocks begins to carry the weight of the entire market's optimism. Indexes rise. Headlines turn positive. Confidence returns. But underneath the surface, breadth narrows, more stocks lag. Valuations stretch, risk concentrates, and most people don't notice because the story still sounds good. We've seen this pattern before in the late 1990s, in pockets of the 2020-2021 rally. Markets didn't fall because innovation stopped. They fell because expectations became too heavy for reality to support. Here's a quiet truth many investors overlook. Markets don't crash when things are bad. They crash when things are priced as perfect, when growth is assumed, when risk is dismissed, when alternatives feel unthinkable. That's when narratives do the most damage. Let me share a small but important lesson. Stocks are not dangerous because they go down. They're dangerous when people forget why they own them, when stocks stop being ownership in businesses and start becoming symbols of belief. Belief without discipline is not investing. It's hope. This doesn't mean stocks are worthless. Far from it. It means selectivity matters more than ever. It means understanding why capital is flowing into equities and what might cause it to leave. Because money that enters on narrative can leave just as quietly. And that brings us to the natural next question. If bonds are questioned, cash is eroding, income assets are repricing, real estate is weakening, and stock narratives are stretched. Where does money go next? Not where headlines point, not where hype screams, but where capital quietly seeks balance. In the next section, we'll explore the assets that tend to benefit when systems reset, not because they promise miracles, but because they serve a role money still needs. Let's take a closer look. When familiar shelters begin to feel uncertain, money does what it has always done. It adapts. Not dramatically, not all at once. Quietly, patiently. It looks for places that still serve a purpose. Here's the first thing to understand. Capital doesn't move because it's excited. It moves because it needs something. Protection, stability, optional growth. And in times of transition, money isn't searching for the best story. It's searching for the right role. Let's start with something old, gold. Not because it's exciting, not because it promises innovation, but because gold doesn't depend on anyone's promise. Throughout history, when confidence in currencies weakens, gold quietly regains attention, not as a way to get rich, but as a way to not get poorer. It's not about price spikes, it's about preservation. Then there are real assets tied to necessity, energy, resources, materials that the world still needs to function. These assets don't rely on narratives, they rely on demand. Even when economies slow, energy still powers homes, hospitals, and industries. Copper still carries electricity. Resources still build infrastructure. Capital flows here not because it's fashionable, but because reality doesn't pause. Now let's talk about something more modern. Technology, not as hype, but as productivity. Not every tech company benefits in a reset, but those that reduce costs, increase efficiency, or replace manual labor with systems often become more valuable when margins tighten. In uncertain times, businesses don't experiment, they optimize, and capital follows that instinct. You'll also hear more conversations about digital assets, not because they've replaced traditional finance, but because they exist outside of it. For some investors, assets like Bitcoin represent an alternative system, one that doesn't rely on policy decisions or central banks. It's not a guarantee, it's an option. And options gain value when certainty fades. Here's the small lesson most people miss. Winning assets in a transition are not always the ones that grow the fastest. They're the ones that lose the least while maintaining flexibility. They preserve purchasing power. They offer optionality. They don't require perfect conditions to function. Capital, in moments like this, isn't chasing returns. It's buying time. Time to see what stabilizes. Time to see which systems endure. Time to move again when clarity returns. And this brings us to the final piece of the puzzle, because knowing where capital might flow is only half the equation. The other half is positioning. How do you prepare without pretending you can predict the future? How do you stay flexible without freezing in uncertainty? In the final section, we'll talk about the mindset and framework that allows investors to survive transitions and quietly benefit from them. Not by guessing, but by positioning. Let's bring it all together. By this point, one thing should feel clear. The future is uncertain, and anyone who claims to know exactly what will happen next is guessing. Smart investors understand this. That's why they don't try to predict the future. They prepare for it. Prediction sounds powerful. It feels confident, precise, comforting. But prediction breaks easily. One unexpected policy decision, one geopolitical shock, one shift in behavior, and the forecast falls apart. Positioning, on the other hand, is quieter. It accepts uncertainty instead of fighting it. Let me tell you how experienced investors think during moments like 2026. They don't ask, will the market go up or down? They ask three much calmer questions. Where is capital likely to move next? Who is forced to sell right now? And how much flexibility do I have if I'm wrong? These questions don't require certainty, they require awareness. Think about someone who went through multiple cycles. They didn't win because they timed the bottom perfectly. They won because they didn't need to. They kept optionality. They held assets that could survive volatility. They avoided structures that forced liquidation. And when opportunities appeared, they were ready. Here's a simple real-world example. During downturns, some investors panic because their assets demand action. Margin calls, debt payments, yield promises they can't afford to miss. Others remain calm, not because they're smarter, but because their structure allows patience. Same market, very different outcomes. This is the heart of the survival framework. Don't build a portfolio that depends on perfect conditions. Build one that can endure imperfect ones. Diversify not just across assets, but across roles. Some assets protect, some provide optional growth, some simply buy you time. Here's the small lesson that ties everything together. Markets don't punish ignorance immediately. They punish rigidity. You reap. Those who survive transitions are not the boldest. They're the most adaptable. They don't chase certainty. They maintain control. As we move deeper into 2026, volatility will test conviction. Headlines will push emotion. Narratives will promise safety. But remember this, money never disappears, it moves. And those who understand where it moves and why are rarely surprised by the outcome. This moment is not a warning, it's an invitation to step back from noise, to see the system clearly, and to position yourself with intention. Because when the next chapter is written, it won't belong to those who guessed correctly. It will belong to those who were prepared. Thank you for spending this time with the Hidden Mind. If this perspective helped you see the market differently, take a moment to reflect, not on what to buy next, but on how you want to think moving forward. And when you're ready, we'll continue exploring the systems that shape our financial world, quietly, clearly, one step ahead.